Friday, January 30th, 2026 won't be remembered as a bad trading day. It will be remembered as a moment the entire world watched a paper price collapse in real time, the way people watched 1980 and realized the rules can change overnight. Gold didn't drift lower, it dropped like a trapdoor. Silver didn't correct, it detonated. In a single session, gold fell from its Thursday peak above $5,590 to under $4,900, and silver went from the edge of $120 to the mid-80s, briefly even lower depending on the feed, erasing roughly $35 in hours. That's not a pullback. That's a liquidation event, so violent it rewrites psychology in one afternoon. And if you're sitting there feeling betrayed, replaying your decisions, wondering if the bull market just died in your hands, you're not weak for feeling it. That reaction is the point of moves like this. The market doesn't just take money, it takes certainty. It takes your timeline, your confidence, your story. It makes you ask the wrong questions at the worst time. Should I have sold? Is it over? Was I the exit liquidity? Those questions flood your head because Friday didn't feel like fundamentals. It felt like a switch being thrown. Now here is the claim you were seen everywhere, that this was Trump-esque betrayal, that the crash was planned, that the White House flipped the table and crushed precious metals on purpose. I'm going to be careful with that language because markets are full of narratives that sound satisfying and turn out to be incomplete. But I will tell you this, the timeline is too clean to ignore, the messaging is too contradictory to dismiss, and the chain reaction is so textbook it looks engineered even if it wasn't. In other words, whether this was strategy or chaos, the effect was the same. The dollar spiked, leverage snapped, and metals paid the price. So let's treat this like market forensics, not a rant. Because in market forensics, the sequence matters. Tuesday, January 27th, confirms a policy vibe. Friday, January 30th, detonates it. And somewhere between those 2 days, traders built a consensus that became fragile enough to shatter. Start with Tuesday, January 27th, 12:45 p.m. Eastern in Urbandale, Iowa. The dollar index had slid to a 4-year low around the mid-95s, and the president is asked directly about the dollar's decline. He doesn't hedge, he doesn't soften it. He praises the idea, framing a weaker dollar as an advantage for selling American goods, the same argument he repeated before. A strong dollar sounds good until you try to sell trucks, tractors, anything real. Markets heard that as a signal, not just rhetoric, but a permission slip. The trade became crowded for a reason. Weaker dollar logic points toward easier financial conditions, and easier conditions are oxygen for gold and rocket fuel for silver. Now jump to Friday morning, January 30th, between 4s and 4:23 a.m. Eastern. A post hits that changes the tone instantly. The nomination of Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. That name isn't neutral in markets. Warsh is widely seen as a credibility-first, inflation-wary, balance sheet reduction kind of figure. Even if you agree or disagree with that worldview, you know what algorithms do with it. Hawk, QT, sound money, stronger dollar, less liquidity. The moment that headline hits, the market doesn't debate nuance. It reprices the future. Before we go further, if you want more investigations like this, where we connect the political timeline to the plumbing under the charts, like the video and subscribe to Money and Empires right now. Because what matters next isn't just the crash. It's what the crash revealed about who was leveraged, who was trapped, and who gets forced to sell first. Here acts the contradiction you can ignore. Tuesday, S-message rewarded a weaker dollar narrative. Friday's nomination signaled a stronger dollar, tighter liquidity trajectory. Both cannot be true at the same time without something giving way. Either the Tuesday posture was political theater, or the Friday choice was a strategic pivot, or the administration is sending mixed signals that markets can't price without violent readjustments, and markets punish uncertainty faster than they punish bad news. So the dollar jolts upward. When the dollar moves like that, metals don't get time to negotiate. They get repriced. And once metals start sliding, the real monster wakes up. Leverage. Because the most dangerous thing about a crowded bullish trade is not that it's wrong long term, it's that it becomes structurally fragile short term. When Friday's headline hit, you didn't need a conspiracy for the next step. You just needed positioning. Gold had gone parabolic, silver had gone vertical. Indicators were screaming stretched, the kind of conditions where price is no longer climbing on healthy demand, but on momentum, FOMO, and borrowed money. Gold's RSI pushing into extreme territory, silver trading absurdly far above long-term averages. Those aren't moral judgments, they're warning labels. It means the market is one shock away from a vacuum. And then the vacuum opened. The dollar spike was the spark, but the fire was margin. This is where the crash starts to rhyme with 1980, not because the world is the same, but because the mechanism is the same. Forced liquidation beats conviction. In 1980, it was rule changes and margin pressure crushing silver into Silver Thursday. In 2026, it's a different set of triggers but the same physics. When your broker wants collateral now, you don't sell what you love, you sell what you can. The most liquid positions become the ATM. Gold becomes cash. Silver becomes collateral. Mining stocks become collateral damage. Now add the second layer that made this worse, cross-asset stress. If you watched Thursday's action in big equities, you saw the kind of moves that generate margin calls across portfolios. When a major position gets hit hard, funds don't calmly rebalance. They raise cash. Prime brokers don't ask politely, they demand collateral. And the fastest way to meet that demand is to dump liquid winners, exactly what gold and silver had been. That's why this didn't look like profit-taking. It looked like a waterfall. Gold dropping from record highs toward the high 4,000s, silver collapsing from triple digits into the 80s, ETFs getting hammered, leveraged products amplifying pain. And then mining equities, already high beta, getting obliterated as if the market suddenly decided the entire sector needed to be repriced for a new regime. So what was Friday really? It was the market suddenly pricing the end of easy money certainty. Whether Warsh is confirmed or not, the headline forced traders to confront a possibility they weren't T-positioned for, rate cuts without the comfort blanket of endless liquidity injections and balance sheet reduction treated as policy, not a footnote. Gold at $5,600 was priced like the system would always choose inflation and liquidity. Gold under $4,900 was the market briefly pricing a world where the Fed tries credibility first. Even if that world can't last, the repricing can still be brutal. Now let's address the political story carefully, because this is where people either get hypnotized by a villain narrative or they miss the real lesson. Did Trump plan the crash? I can't prove intent, and neither can anyone responsibly without evidence. But intent isn't required for impact. What we can say is this. The messaging sequence created a policy whiplash that markets treated as regime risk. Weak dollar praise, followed days later by a perceived strong dollar QT-leaning Fed chair pick, is the kind of contradiction that forces a violent rethink, especially when positioning is already crowded and leverage is already stretched. And the confusion didn't end there. Other officials sent signals pointing in different directions, adding toxicity to the mix. Markets can tolerate bad policy if it's coherent. They cannot tolerate incoherence when trillions are priced off expectations. That's how you get the kind of day where everyone rushes for the exit at the same time. Where stops cascade, where liquidity disappears right when you need it, where silver moves like a meme stock and gold trades like a forced sale asset. The cruelest part is who gets hurt. Retail flows chase strength late. They buy. After the story feels confirmed, they buy at 110, 115, 120 because the narrative finally feels safe. Institutions sell into that strength because they understand what crowded looks like. Then one headline hits, and the late buyers learn the oldest lesson on Wall Street. The market doesn't ring a bell at the top. It rings a siren on the way down. So here's the question I want you to sit with, because it determines how you'll interpret everything that happens next. In a world where politics can flip the perceived Fed trajectory in a single post, and where leverage can turn a bullish trend into a bloodbath in hours, what do you actually own when you own gold and silver? An asset with fundamentals, or a trade that lives and dies by liquidity conditions? And if the answer is both, which side are you positioned for right now? Drop your honest take in the comments. Do you believe Friday was a strategic reset that clears the deck for the next leg, or a warning that the system will protect itself by crushing crowded trades whenever it needs to? And while you're there, tell me where you're watching from. Because this wasn't just an American story, it was a global risk signal. Now the part everyone wants, because pain always asks for a verdict. Is the bull market dead? Here's the truth that doesn't fit neatly into a tweet. A liquidation event can be true, and the long-term thesis can still be true. Friday didn't erase the structural drivers that pushed metals up in the first place. It exposed that too many traders tried to ride those drivers with leverage and perfect timing assumptions. Central banks don't buy gold because RSI is overbought. They buy because the world is fragmenting and reserves are becoming political weapons. Debt dynamics don't disappear because silver fell $35 in a day. If anything, the sheer size of sovereign obligations makes sound money theatrics hard to sustain in practice. You can talk tough about balance sheets, but you can't talk your way out of a debt trajectory that demands either austerity, default, or inflation over time. That's why, even after a crash like this, institutional price targets often don't instantly vanish. They may pause, they may adjust timing, but the macro engine is still there. Silver adds a second engine that gold doesn't have. Industrial demand tied to electrification, solar, data centers, and the physical supply chain. That doesn't mean silver can't crash. Friday proved it can. It means that once leverage is flushed, the metal tends to find real buyers again, not just momentum buyers. The most important shift after days like Friday is not the exact low print. It's the change in who is left standing. When the weak hands are forced out, when the late leverage is wiped, the market can start building a base for the next phase, if the macro backdrop reasserts itself. But Monday matters. The dollar matters. Policy messaging matters. If the dollar keeps ripping and risk markets stay stressed, metals can still feel more pain, because liquidity rules in the short run. If the dollar fades and the policy story fractures again, metals can snap back faster than anyone thinks, because oversold conditions after a waterfall don't politely recover. They whip. So here's where we land. Friday was a brutal reminder that parabolic moves end in tears and that politics can be gasoline when positioning is a powder keg. But it was also a revelation. The entire system is still priced off confidence in liquidity and credibility. If Warsh represents a real credibility pivot, metals may consolidate and rebuild while markets relearn what two-way risk feels like. If the pivot is cosmetic, or the policy line snaps back toward debasement, this crash will look less like the end and more like the reset that made the next leg possible. Was this a brilliant strategic repositioning, or a historic policy mistake? Was it betrayal or a forced recalibration the market needed? Tell me what you think, because your answer reveals how you'll react to the next headline. And whatever happens next, don't look away. The bull market isn't dead. It's becoming violent again. And in violent markets, the people who survive aren't the ones with the hottest takes. They're the ones who understand the mechanism.